Hello, my name is Sandy Chim, President and CEO of Century Global Commodities. I'm here in the next few minutes to share with you our top level analysis of the global seaborne iron ore market. Hope you find it interesting. Let me bring to your screen our presentation, just a few slides to hopefully tell the story better. What you're seeing on your screen is actually the global seaborne market over the last 13 years, since 2009, when the spot and futures market of the seaborne market for the first time came into play. It was always over the last almost half a century, the iron ore market was traded on long-term, negotiated long-term contract basis. But 2009, the spot market began and went to its peak. And as a result of actually the big expansion we'll speak to a little bit later, that the iron ore price collapsed with the collapse of the super cycle. But then when the big expansion spree was over, iron ore price slowly came back up. Over the last couple of years, it came to a peak in 2021 mid-year to over $230 per ton, which is historic, even higher than the last super cycle's peak. And you can see actually this span of fluctuation of the iron ore market as a result of a very liquid but volatile iron ore futures market and spot market is recovering over this span. And you can see that strong recovery from its bottom now going into a new cycle. But we're going to speak to the new cycle is very different from the last. Let's look at the fundamentals of the iron ore market. On demand side, obviously, the elephant in the room is China, the market. China actually started pretty low at the beginning of the century with steel production just over 100 million tons a year. But a couple of years ago, China's total steel production went to over 1 billion tons more than the rest of the world. So during this period, China actually have depleted its own national iron ore resources and therefore had to go overseas importing iron ore. You can see in the slide that the import, which is in the red bars, from about 70 million tons a year in year 2000. It went to a plateau by about the mid-2010s to about 800 million tons and stayed there for a few years. And then it resumed its growth to now over 1 billion tons. And this is going to stay here for some time to come. And particularly with the recovery from COVID-19, the iron ore demand is going to be very favorable, not just in China, but globally. So on the demand side, the fundamentals are looking very good. Look at the supply side. It's very strange, actually, the iron ore sector, although it's bulk commodity, it is actually an oligopoly, very different types of economics in terms of supply. What you're seeing here, this slide summarizes for you the big four mining companies. They started with only big three about 10 years ago, or over 10 years ago, when the big three at that time, BHP, Rio Tinto, and Vale, produced in total about 2006, slightly less than 500 million tons of iron ore a year. But then FMG came into the picture, planning to produce close to 200 million tons a year of iron ore. That got everybody excited, and therefore all the other big guys were going to an expansion spree. You can see in this slide, the bar graphs represent the capex, capital expenditure that they spend during all these years into actually expanding their production. Within about 5 to 7 or even 10 years, they were able, now the big four, not the big three with FMG in the group, is producing more than double just a few years back. And they completed their expansion about 2015 to have taken actually less than 500 million tons of annual supply in about 2006. By 2015, they were over 1 billion tons, more than double of where they were before the expansion within very short time, considering the kind of capex expansion they had to go through. And then throughout the rest of the period until now, the total big four producers were producing close to only 1.1 billion tons plus or minus, and staying there very steadily. Now you can see actually in this slide that the capex has been reduced from the peak of almost close to $30 billion in total for everybody, down to maybe about 5 or 6, and then now approaching about 10 billion tons a year. I would say mostly sustaining capital. And nothing has been seen so far in the market that these big four mining companies were going to any big expansion plan as before as about 10 years ago in order to catch up with the price. So they're pretty stable and steady-handed to maintain the production over the last few years and in the foreseeable future. I'm showing also the net outstanding performance of the Big Four. You can see over the last 10 years, they've done a good job in managing the costs, cash costs particularly, from, the peak was some producing like $50, $60 a ton. This is all in US dollars. Some are more competitive, but over the last 10 years, everybody's been able to drop and decrease their production cost down to roughly about $20. They're about some a little bit over and some under. So with that competitive cost structure, landing in China, probably we're talking about, even in today's market environment, about $30, $40. But the iron ore price today is trading about $150 and $160. If you look at the middle part of your screen, you can see actually the EBITDA of the Big Four mining companies, how they have performed over the last 10 years, how they were affected by their own expansion plan, and how they actually were recovering from that, creating a stable environment in terms of production, and therefore setting themselves up for a run for this new cycle, enjoying high iron ore prices. You can see at the bottom in the middle chart that they together, the EBITDA was dropping from about $70 billion a year down to only less than half, $30 billion a year. But then iron ore prices, after the expansion, the market corrected itself and setting itself up for high price environment. And every year, EBITDA was growing since the bottom. And in 2021 last year, they were able to deliver over $100 billion of EBITDA in total, considering they put in, you saw in the previous slide, roughly about $100 billion to have taken their production from 500 million tons a year to over 1 billion tons a year. They made more than a few times of the $100 billion. In just 2021 alone, they made over $100 billion. To reward their shareholders for hanging on, trusting management, on the right-hand side of your screen, you can see actually the dividend the Big Four mining company has been paying dividend, an extraordinary special dividend back to their shareholders. I believe one of them, they paid a record dividend to their shareholder on the market. And you can see by 2021, they came from the bottom of less than $10 billion of dividend a year in total for the Big Four to over $35 billion of dividend. And therefore, you see actually not much capital the Big Four felt needed to be kept for the company's future expansion. And they've been spending, you can see in the last slide that in total last year, 2021, over $10 billion of sustaining capital. So the market condition going forward until we see announcements of big expansion, we haven't done that. We haven't seen that yet. The market is going to stay where it is today. And this next slide summarizes very well, actually, the market dynamic, the very key market dynamic of this oligopolistic iron ore market. You can see actually on the very far left-hand side of the slide that pie represents the total supply. And the Big Four constitute some 70% roughly of total supply to the global seaborne iron ore market. In the middle, the pie represents how much China, or the global imports, including China, and China being the biggest customer, buys over 70% of iron ore, global seaborne iron ore from the market for China's steel production. On the very far right-hand side of the slide, you can see the pie. China relies on imported iron ore, some over 80%. So that summarizes how the Big Four, although they don't sell every ton to China, but sell very much to China, they track their production and the buying of China as import of iron ore very closely. And that's the biggest piece of actually observation that drives the oligopolistic economics of iron ore market today. In this last slide about the market, I sort of take the two biggest supplier, the Big Four together, and the biggest customer, the end user of iron ore, and put them in terms of a graph to see the trend over the last 10 years or so, how they track closely to each other. Very interesting to observe that actually you can see the solid blue line representing the total production the big four mining companies sell into the market, and the light blue dotted curve shows the Chinese import. And you can see over the years, even going back to as far as 2006, we jumped to 2011, and all the way through the last 10 years, the two curves, although the big four do not sell every ton to China, and China does not buy everything from the big four, although China buys a lot and substantially from the big four, the two lines, major supply and major demand, track very closely. Although they track very closely, what is interesting is you can see the red dash line represent the iron ore price. You can see it started from the peak and now coming back to a peak again. But that's not the peak for this market yet, as we can see, because throughout this period, what drove the iron ore price down was actually the big expansion of the oligopolistic economics or economy of iron ore, from going from big three to big four, going through big double expansion plan, taking their production from 500 million tons to over 1 billion tons in a short few years. That dropped the price. But now price is recovering, and you can see actually since 2015, either production or demand from China goes very smoothly, hand in hand, relatively balanced and stable over this period. But the iron ore price has gone up from the bottom of $50, $60 to over $160 in 2021 and staying there. We see this continue for some time to come until we see another major supplier, new kid on the block coming into play, or we see a demand collapse, none of which we see happening in the foreseeable future on the horizon. And as the last couple of slides we share is about our company as an iron ore company. We have our iron ore projects adding to some 20 billion tons of iron resources as a company, all from the same location, Labrador Trough or Eastern Quebec, Western Quebec of Canada. And this 20 billion tons, we have over a few projects going from the most advanced feasibility study of George Lake and the other two projects and preliminary economic assessment stage, and all they have 20 billion tons and adding to a total net present value of these projects based on iron ore prices lower than the market today of some $5.3 billion. This slide shows you the number on the right-hand side, how the project's NPV values add up. And on the left-hand side, you can see actually our snapshot of the company's financial standing. And you can see that we are trading only at about $27 million of market cap, fully understanding that the market takes some time to grasp with the kind of dynamics the market is looking at in terms of the global seaborne iron ore market today. It would take a few more months or so for the market to be convinced that the iron ore market has come back for a good few years to stay, and therefore giving us a window to realize the value of the project and therefore advance them one by one, hopefully to production at some time in the future. Thank you very much for your time listening to us. If you have any question, please do send us your questions. Look forward to talking to you. For now, until we see you again, have a good rest of the day. Bye for now.